This is the #1 way first-time buyers get hit after closing. Working capital. You buy a profitable business, and after close, you realize you bought a cash timing problem. Today, I'm going to explain working capital in plain English. And I'm going to show you the clause that saves buyers 6 figures, if not millions. If you want my buyer pack, comment SBA below and I'll send it to you. Let's go. Working capital is the money a business needs to operate day to day. It's not theory. It's not accounting trivia. It's payroll. It's paying vendors. It's keeping the lights on while you wait to get paid. And here's the truth. Most buyers don't go broke from losses. They go broke from timing. Here's the simplest example. Let's say your customers pay you in 45 days and you pay your employees every week and your vendors want to be paid in 30 days. So what happens? You're floating payroll and expenses for your vendors while you wait to collect from your customers. If you don't have enough working capital, you will feel profitable on paper, but you're stressed in real life. That's the trap. Why does this surprise buyers? Because sellers always understate working capital needs. I had a scenario where I was sitting across from a couple selling a business. I asked both of them, what do you think the working capital needs are? The wife says, oh, we probably need about 800,000. And then the husband says, oh, you can run it for 150,000. Now they're running the business together and they cannot agree on what their working capital needs are. It's just the reality. They've learned the rhythm of the business. They have really good vendor relationships. They know the seasonality. They know the cash cycle. You're inheriting that machine. And if you underfund it, it will stall. This is where working capital peg comes in. A peg is a target level of working capital that the seller must deliver at close. In other words, you're not buying a business empty. You're buying it with enough fuel to operate. Now, how do you set that working capital peg? Usually you look at the last 12 months and isolate the 3-4 months where you have the highest needs, and you do an average of those 3 months. Because you don't want to be counting an average of the whole year, and some months have low capital needs, some months have very high capital needs, and if you go too low in the average, then you're going to be stuck in those high months. You need to adjust for seasonality. If the business is seasonal, and most of them are, and you pick the wrong month, you get tricked. So you want a look-back period, a clear formula, a true-up mechanism after close. That true-up matters because numbers at close can be manipulated by timing the payments. So your agreement should say, we'll reconcile after close, and the seller makes you whole if the peg wasn't delivered. Here are some red flags you keep an eye on. Whenever you see in the balance sheet big account receivables, and you look at the AR aging and you see slow paying customers, or they're holding a lot of inventory, that means 6 months, 1 year worth of inventory, or you see seasonal spikes, and owner-operated chaos. If the seller runs the business on relationships and instinct, you need more cushion, not less. Working capital is not a footnote, it's survival. If you negotiate it right, you protect your downside. If you ignore it, you can buy a profitable business and still feel broke. Comment SBA and I'll send you the buyer pack, including the clause language and the diligence checklist. And if you're buying a business in the next 12 months and want a structured process, apply for the Acquisition Collective.